American stocks falling after those big bank earnings kicking off this morning. We had shares of JPMorgan, Citi, and Wells Fargo. They were moving after this net interest income concern coming out here. Now all of these stocks moving to the downside. Citi had been up earlier this morning. Looks like now after digesting that report, we're seeing it coming down a little bit here. To discuss more of this, we are joined by Cameron Dawson, NewEdge Wealth Chief Investment Officer. Cameron, great to meet you officially. So excited to have you on this morning. I do want to start on these bank earnings because I'm curious from your perspective, what's standing out most to you about which of these firms is able to kind of withstand this higher for longer environment, and what else is seeming like the big headline for you this morning?
Well, we think that the largest banks are the ones that are going to be able to deal with higher for longer far better than the smaller banks, which we'll start to hear from more next week. Really, the thing that we're listening for very closely from the banks is their discussion about credit health, not just for consumers, but also for corporations. How are those end customers dealing with a higher for longer environment? And what we are hearing from the likes of JPMorgan is that they keep using this term normalization, which just means that we're seeing things get back to more normal levels and territory post the pandemic, where you saw things be in very odd levels for quite some time. So think of things like credit delinquencies or the percentage of balances compared to disposable income. All of these things are getting worse, but they're just normalizing. So the biggest thing for us to watch is, does normalization turn into outright weakness, meaning that there's bigger credit issues under the surface?
Cameron, what do you think the likelihood of that is now?
I think that we're starting to see signs of fraying in those smaller businesses as well as lower income borrowers. So if you look at the aggregate numbers, it can be rather misleading. They all look still very healthy, but there are certainly signs and pockets of weakness. And it's where we're also listening very closely for as we go through this earnings season is, what are consumer companies saying about demand from consumers? We've seen this incredible ability for consumers to deal with higher interest rates, higher inflation, and just keep on spending. But are we starting to reach levels where we've seen real wage growth start to kind of sideline versus the increases we had been seeing? Are we seeing the levels of debt kind of reaching a ceiling of how much can be tolerated? If we're hearing signs of that, could we start to see consumer spending slow down? And that's very important, of course, for GDP estimates, given the fact that consumer is 70% of GDP.
And the consumer looking a little bit more frustrated with the inflation picture this morning off of that consumer sentiment index, which reminds me of Jamie Dimon not really wanting to talk about the recession elephant in the room with media this morning. I'm curious from your perspective, how likely is the recession scenario versus a potential no landing scenario?
Yeah, I mean, it's been incredible, the shift in narrative over the last 12, 18 months between the absolute certainty of a recession to now the absolute certainty of having no landing. The thing for us to watch, and we keep calling it probably the most important chart in markets right now, is GDP growth estimates for 2024. What we saw over the course of the last few years is those estimates were slashed in 22, but starting in mid-23, they started to rise quite significantly. And in this year alone, we've added about 100 basis points to GDP forecasts for 24. And now we're sitting at 2.2%, which is effectively that no landing kind of scenario. So the big question is, can we stay at that 2.2% estimate? What could potentially drive it higher? Or what could be those drivers that we could see estimates revised lower, which really would be a shock given now that we have pretty much consensus completely on soft landing camp.
Cameron, what does all this mean potentially when we take into account that we could be in this higher for longer rate environment, maybe potentially with the Fed? There are odds that we might not even see a cut this year. Specifically, what does that mean for tech, which had been a leader last year? And we have seen some signs of life, especially when you take a look at some of the moves that we're seeing, Google today and Apple yesterday. Is there signs, though, that they could potentially be a leader if there is no rate cut?
Yeah. Well, big tech, mostly those companies with big, huge cash balances and not a lot of debt, love higher for longer, meaning that they're still earning really high rates on their cash. They're not having to go to market and refinance at higher rates simply because they termed out debt when rates were so very low. So big tech is a defensive trade in that way because of its balance sheet, which raises then the point of what do you do with lower quality balance sheet parts of the market, your small caps and other parts of the market where you do know that you have big refinancing that starts in late 24 and 25. Those are the names that don't like higher for longer. Those are the names that are going to see their interest costs go up rather significantly as they refinance, and likely is why you're seeing overall net income pressure in those low quality areas. So big tech ends up being a safety haven trade in a world where rates do stay higher for longer.
So Cameron, given that, is every dip in the Magnificent Seven buyable?
Possibly in the short term, but the thing we're watching the closest with the Magnificent Seven is that they've had an incredible run of earnings, and earnings are extraordinary for the first quarter. You have big, huge earnings jumps for Nvidia, Google, Amazon, Tesla, and Apple, not so much. But what happens as we move into later 2024 is that earnings growth pace starts to slow rather materially. You even have forecasts for earnings growth for the rest of the market being higher than the Mag 7 by the time we get to the fourth quarter. Whether that materializes or not is a question, but I think that we have to remember that markets trade on second derivatives. They trade on the rate of change of growth. And so as we see this growth start to slow down for Mag 7, will they be as attractive names? I think that's more of a question for 25, which is why dips are likely buyable over the short term for the Mag 7, but then we have to watch them very closely as we round the corner into the back half of this year and into 2025.
All right, Cameron Dawson, NewEdge Wealth, the Chief Investment Officer. Always great to have you. Thanks so much for joining us here this morning.
Thank you.